Good afternoon to all the participants and the panelists on this lovely Thursday. I'm Chartered Accountant Omar Abdullah, and I will be the moderator for today's session. Today's discussion on juridical double taxation is a pertinent topic in an increasingly globalized world. India, as the leader of the Global South, has been setting the agenda for the global tax matters, and therefore today's topic is all the more relevant. I take this opportunity to welcome the dynamic duo of Direct Taxes Chairman CA Piyush S. Chajat and Direct Taxes Vice Chairman CA Kota S. Srinivas. CA Piyush S. Chajat is a chartered accountant practicing for the last 20 years and carrying forward the service legacy of a proud father, CA SP Chajat, ex-president ICAI. He is a senior partner at Chajat and Doshi Chartered Accountants. He specializes in direct and indirect taxes appellate proceedings and arbitration proceedings. He is a speaker on various topics of direct taxes, a member of external committee of RBI Asset Reconstruction Committee, a vital contributor to WIRC publications on Vivad Se Vishwas. CA Kota S. Srinivas is a current Central Council member of ICAI. He is a BCom graduate from Bangalore University and a fellow member of the Institute of Chartered Accountants of India, and also a member of the Institute of Cost and Works Accountants of India. He is a member of SSB and Associate Chartered Accountants Bangalore. He has a long history of serving the institute right from his service days, and his service history spans over 2 decades. He has served 2.5 years as a student committee member of SICASA Bangalore branch, 9 years as managing committee member of Bangalore branch of SIRC of ICAI, 9 years as a regional council member of SIRC of ICAI. His contributions and achievements are many. He prepared concept paper on coaching classes as chairman of academic advisory group. He was instrumental in developing digital project for SIRC. He implemented improvised IVR system for members and students, ensuring it is made available in 6 languages. He has ensured infrastructure development at SIRC. And further, his social contributions are many from the CABF fund and others. Honestly, sirs, both of you need no introduction, owing to your popularity among members and students for all your fantastic initiatives. Our speaker today, CA Prashant KL, whom I've had the privilege of interaction on a personal basis occasionally, has the most interesting and refreshing perspective on a range of tax matters. And sir, I'm eager, along with all the participants, to take away valuable insights from today's deliberation on this important topic, as this topic touches every tax practitioner, as Form 15 CA CVs have become a matter of routine. CA Prashant KL is a chartered accountant with 22 years of experience. He has a bachelor's degree in commerce from Bangalore University, a diploma in information systems audit, certified under the international taxation course conducted by ICAI. He is also a graduate from Hubli University. He is a partner taxation and research team at Guru and Jana. His specialization is both indirect and direct taxes. He has co-authored book on international taxation published by KSCA. He is a co-author of book on GST, Where Did My Profits Go? An illustrative narrative of GST law. He is a speaker at various ICAI forums and at the prestigious Direct Taxes Regional Training Institute of the Honorable Income Tax Department. He has presented papers nationally and internationally. Now I hand over the session to CA Piyush Chajat.
Thank you very much, Omar Abdullah, the moderator for the day. Thank you also for accepting our invitation. My Vice Chairman, CA Kota Srinivas from Bangalore. Prashant KL, speaker for the day. Thank you very much, Prashant ji, for accepting it and choosing such an important topic of judicial double taxation. It's a very important in today's time. Generally, very good afternoon to all the participants who are present over here. As I'm speaking today, myself and my Vice Chairman Kota sir we have just come out of a council meeting, wherein a very important discussion was going on, and the chairman of our National Financial Reporting Authority, the way we call NAFRA, Mr. Ajay Bhushan Pandey, has today joined our council and he's addressing the council meeting. I thought I'll just update all the members over there that he's addressing the council. Currently, it's going on in the parallel room itself. Apart from that, just to take it forward, yesterday myself, my vice chairman, along with Mr. Sanjay Agarwal, the council member, we had made a presentation on a pre-budget suggestions, what we call pre-budget memorandum, to CBDT chairman. CBDT chairman and the team from the policy gave us a very, very patient hearing. We presented gave all our suggestions in a PPT format as well as in the booklet format. And also we presented and discussed important suggestions which were there, which included amendments in 43 capital B, the problems which have been faced. Then the section special tax rates as far as 115 BB is concerned, as far as DMIC provisions is concerned, and many other such suggestions were made. And total 90 minutes discussion happened with them. And they have assured us that positively they will look into it. And wherever they feel appropriate, they will also try to bring in necessary changes in these provisions. So I thought I'll just give you a brief background. This is a development which has happened at our direct tax committee in last 2 days. Apart from this, regular webinars, which we are having every weekly on Thursdays, generally which one Thursday we have for international tax and alternative we have for any direct tax topic. Likewise, this Thursday, we are having on international taxation where we will be discussing on double taxation. Last year, we had discussed on charitable issues in the charitable trust matters. That was a part 1 and part 2 will be coming soon. So my request to your participants is please keep engrossed to this channel, live TV. This channel, whatever has been recorded today, will be also hosted. So if somebody is not able to join live, you may tell your friends that this particular recording would be available on the ICI live TV also in a day or two's time, which they can watch any point of time whenever they want at their convenience. So with this background, I thought what DTC is doing, I'll just very shortly, within 2 minutes time, I'll try to cover up. Sooner, we have two important work on our hand. One is 2 publications which will be coming up within max 2 to 3 months. One is guidance note on audit of charitable institutions in Form 10B and 10BB. As you are aware, last year we had come with an implementation guide. Now that implementation guide will be converted into a guidance note. For that purpose, exposure draft will be released soon. Maybe in 2-3 days time, exposure draft will come. So to all my participants, all members, please request, tell your branches also where you belong to, all your friends, whatever suggestions you have, which you would like to get incorporated in your guidance note, please do write to us. Because once the exposure draft is there, it will be open for 21 days. You can actually comment upon it. You can write to the institute. We'll try to discuss that, sort it out in the committee, and if well appropriate, we'll make an adequate changes in the guidance note also. Secondly, we will be very soon. A first draft has already come on an implementation guide and revisions of Form 3CB, which include most important revision, that is in regard to 43 capital B. A first draft has already come. The group has been formed who has given their first comments. After that, this will be discussed again amongst the group members. Thereafter, it will come to direct tax committee and then it will go to the council probably. We may, because implementation guide can otherwise be released even by approval of the direct tax committee. So these are 2 or 3 important things which I thought I should cover up, which DTC would be doing in next 2 to 3 months. Basically, that's what our note is on about. Coming to importance of international taxation, everybody knows. I know each and every individual member may feel that he is not doing an international tax practice, but technically he is doing. When he is simply issuing a 15 CA Part D, though he is not signing, but he's issuing it in for the purpose of what he is filing it for the clients, or he is certifying Form 15 CB, international taxes involved. You are required to look into the bills, you are required to look into agreements, whether the tax is applicable under Section 9 or not, whether the DTA is applicable or not. And therefore, technically, each and every individual practicing chartered accountant is involved in its practice, in its day-to-day practice in an international taxation. And therefore, the importance of international taxation is going to increase day by day. It is already increased and it is further going to increase day by day. To keep track of that, to make our members aware of them, we are also running a diploma course in international taxation, which is concurrently going on in an online mode. where we have a restriction of 200 participants that is already over. We believe that that course will be completed before 31st of May. Once that course is completed, examination will be held, and the person who cleared that examination will be issued a diploma certificate. Once this course is over on 31st May, we may come with another course also. So whosoever people who have not actually enrolled or who have not completed this course but are wanting to learn about international taxations, please do join that. So with this, once again, I give you a very warm welcome to all the participants, and thank you very much to Prashant KL, speaker, for accepting our request, and the moderator, Omar Abdullah. Over to you, my Vice Chairman, C. Kota Srinivasji. I would request him to kindly address the gathering.
Thank you, Chairman. Welcome all of you for this particular. Am I audible?
Yes, sir.
Yeah.
Yes.
So I welcome all the participants for this particular webinar on juridical double taxation, more specifically topic on international taxation. Let me thank my friends, or I should say my younger brothers, both of them, Omar Abdullah and Prashant Kale. We are all part of one group called Group Dynamics, where we used to sit and discuss week on week on international taxation. Today, I'm happy to see that they're all speaking on international taxation, addressing at the national level. Thank you, Chairman, for giving the opening remarks. In fact, whatever the things we are doing in DTC, the Chairman's prerogative, he has said everything. I don't have much to add for whatever we are doing in the DTC. As he said that we are doing this webinar on every Thursdays, and we have decided 1 week we talk on, we discuss about the direct taxes and the next week, alternative weeks, we talk on international taxation. In that series, today we are having this international tax webinar, where Prashant will be taking us through this juridical double taxation topic. In fact, when you see the DTA, that is double taxation avoidance agreement, the purpose of DTA is to see that there won't be double taxation on a particular person under two countries as such, or there will not be relief of taxation. There is no tax in both the jurisdictions. So more so, I think Prashant will deal about this juridical double taxation in detail in his presentation. The main crux of juridical double taxation means that is a person, assessee is being charged to tax under two jurisdictions. To give an example, if in a financial year, say if you take an example of Indian financial year between April to March, say suppose one person is staying in India from April to December, and then he has gone out of country from January to March, he's staying in some other country. He'll be earning income in India also, and he'll be earning income in the other country also. So whatever the income he earned in other country, it will be taxed in that country also, and being a resident in that particular financial year will be charged to tax in India also. So the same person, the income of the same person will be taxed under two jurisdictions. So this is something called juridical double taxation. How to avoid, how to treat with this? What is juridical double taxation? How to treat, how to tax this juridical double taxation, or how to take relief from this juridical double taxation? Of course, he will take all those provisions in detail. And as I said, we are doing alternatively the international tax topics. We are planning to cover almost all the aspects, important aspects or important articles in the DTA, so that if you participate in this series of webinars on direct tax and international taxation, I am confident that by the end of the year, definitely we'll have more enlightenment on the international taxation as such. Coming to other activities, of course, I am the convener of M&SS, which is one of the important directorate in ICI. As all of you are aware, KYM is one thing which all of you should do year-on-year basis. Last year, most of you would have completed your KYM. And if there is no change in the KYM that you had done, or it has been approved, last year if it has been approved, so this year it will take hardly 30 to 45 seconds to just go through the KYM forms. See that if there is no change in that, please say yes, and it will be approved immediately. And this year, without getting your KYM approved, you cannot pay the membership fees. So I request all of you to do your KYM at the earliest and also pay the membership fees. And coming to the national things, of course, the elections have started. for the general elections. I hope, as a responsible citizen of this nation, each and every one of us will go on exercise our franchise. In fact, in our state, that is Karnataka, tomorrow we have the elections. I wish all the delegates or participants who are listening to this particular program, I wish all of you take yourself and go and with your family and see that you will exercise the franchise and get the best government for our future as such. So with these few opening remarks, once again, I thank Prashant and I welcome both of them for this particular session, and I welcome all the participants. I'm confident that end of this 1.5 hours discussion, you will go back more enlightened on juridical double taxation. Thank you. Over to
Thank you,
Omar.
Chairman and Vice Chairman. Thank you, Chairman and Vice Chairman, for the wonderful updates. Now, without much further ado, I hand over the podium to Prashant.
Thank you, Umar. Firstly, thanks and my namaste to the Alma Mater CA Institute, which gives this wonderful opportunities to express professionals by addressing important topics like this. And thanks to Mr. Piyush for all the initiatives that are going on now. Thanks to Kota sir for perennially guiding many professionals and making many speakers in the process, and doing wonderful work at the council as well. So I will come to the topic of the day. So this is on juridical double taxation. We need to understand when it comes to the taxation as such, what is it that we are trying to explain in terms of the government rights. So the tax is an important revenue as such that comes to the government. So that being the case, it should be constitutionally given right to tax. So the entire tax as such has to be a sovereign power that should be entrusted upon to the government. Based on that, each of the governments across various countries would collect taxes from their citizens or from the assessees, different types of assessees though. So when that is the case, the taxation is charged, that is fine. Then what is this double taxation all about? This is the interesting part we see. In case we are earning a salary income or business income, capital gains, income from other sources, we are supposed to pay the tax, we pay it. So what is double taxation? So in today's presentation, the first few slides will be conceptual understanding. The reason is because few of the people who are just now introduced to double taxation, it will be required for that. So some of the concepts that I discuss here need not be from the perspective of the India taxes. Of course, Indian tax method also is included in the concepts that I'm going to discuss now. But apart from that, those would be the concepts that have developed over a period of at least nearly 1 century now. I'll come back to that history as to why it is 1 century almost. So once those conceptual things we understand, then we'll go into a little bit more detailing into the international taxation. And more fully, we being practicing chartered accountants and doing practice in India, it will be important for us to understand the subject from the perspective of India taxes more fully, although we may take a couple of examples from other countries as well when we are trying to understand the concepts. So first, we understood taxes are a very important source of revenue. And the government is broadly concerned about two things: source jurisdiction and residence jurisdiction. These concepts are very important. So as we proceed further, you will start understanding the importance of these. So why these jurisdictions are important? Based on these source jurisdiction and residence jurisdiction, the constitution of each country empowers the finance ministries or the tax departments to collect taxes from the tax assessors. So source jurisdiction is the source, the place where the source of the income is generated. Residence jurisdiction is the place where a person is residing, as a result of which the taxing right comes into picture. So here it is. The source jurisdiction of taxation means that a country, let us assume that it is your country, India, taxes non-residents, individuals, and corporations on income arising to them domestically, that is in India. So although a non-resident is there, but he is earning income from India. So based on source jurisdiction principle, the country may tax that assessee. So the country taxes income of which it is sourced because of a nexus between it and the activities that produces the income. That is, there is an identifiable and tangible connection between the country and the income earning activity. So the source is always connected to the function, the activity, the place where the activity takes place. That becomes the source jurisdiction. Then comes the residence jurisdiction. It involves the taxation of your country's resident individuals and corporations on income arising in foreign countries, and also in our country also, that is on taxpayers' worldwide income. I have certain examples for this. I'll come back to that. Income is taxed because of a nexus between your country and not the activity this time, but the person that earns the income. So a typical example in this kind of cases can be when a person is treated as a resident in India and he is also treated as a resident abroad. So we'll see those cases as well. So this is from perspective of taxation. Because of source and residence, there can be double taxation. Types of double taxation. What are different types of double taxation there are? First concept is called economic double taxation. Second is called juridical double taxation. Economic double taxation, we already know. The classic example is the dividend income. The taxation of dividends has its origin in the classical system of taxation, which in effect taxes corporate profits twice. Why is that? Based on the profits a company earns, it pays corporate tax on such profits. And profit after taxes may be distributed to shareholders as dividends. So on those dividends, again, the shareholders are subjected to pay the tax. So this is known as economic double taxation because the same profit under two characterization is getting taxed twice. One as the profit in the hands of the company, next as dividend income in the hands of the shareholders as such. So there are a number of means available to tax policymakers to overcome the effects of economic double taxation. Let me go through how economic double taxation can be avoided. So here, as I mentioned to you in the initial slide, the concepts that I'm going to tell now are international concepts. Just take it with warning, because when you're looking at this, you should not, get confused with the taxation laws or the taxation policy that we follow in India. That is why there is important distinction that you have to draw with the concepts that we understand now. And once we understand the concepts, you have to see, okay, which principle India has adopted in order to handle these kind of double taxation, or probably it might not have handled as well. We will see as it goes. Okay. Exemption of income from taxation at the corporate level. So how to avoid double taxation in case of corporate tax and dividend scenario that we saw now, where income derived by a company is exempt from taxation at the corporate level. It nevertheless is subject to tax when it passes through to the shareholder level. But the income is taxed only once, namely at shareholder level, which avoids economic double taxation. That means to say, in case there is an exemption that is given to a company and it is told that the tax would be applicable only in the hands of the shareholder, then double taxation can be avoided. Exemption at the shareholder level, where income derived by a company is taxed at the corporate level, economic double taxation is avoided by exempting from tax the shareholder sides after tax profits distributed by the company as dividend to its shareholders. So economic double taxation can be avoided by giving exemption of income in the hands of shareholders, when they get it as dividend income as such. What is the third method? Full integration of corporate profits in shareholder income. Full integration of corporate profits in shareholder income involves attributing corporate income to shareholders. Income derived by company is then taxed only in the hands of the shareholders. So in such cases is when concepts like pass-through would kick in. For example, you have a limited liability company in the form of a pass-through entity in USA. Shareholders are from India. The company LLC is earning the profits in USA. But because its characterization is as a pass-through entity, it leads to taxable income in US for the shareholders in India. So this is where, although it moves into international tax as well, not just the economic double taxation. This is how it can be avoided that two entities pay tax together. Only shareholder in such cases can pay the tax. Full imputation of corporate profits to shareholders, fourth method. This means taxation is imposed on corporate income at company level, and taxation is also imposed on each shareholder's share of company's pre-tax income. However, to avoid economic double taxation, the shareholder is given a credit for his or her share of tax paid by the company on her or his share of company's pre-tax income. So in these cases, there is a different concept that can come in that goes into the aspects of foreign tax credits. In these cases, it is possible to say that methods like underlying tax credits will kick in such cases, wherein when the company has paid the tax on profits, that being the underlying tax that is already discharged, what comes in the hands of the shareholders is tax paid income. So although the tax is computed, there can be a credit that is given called the underlying tax credit, that is tax already paid by the company as such. So economic double taxation can be avoided in these manners. Then we come to juridical double taxation. So economic double taxation normally is, it can be international, but more fully we connect it from the domestic tax angle. So what is juridical double taxation then? When the taxpayers, either resident or non-resident, engage in cross-border income earning activities, where both the taxpayer's country of residence and the country that is source of income apply either or both of the source and residence doctrines of taxation in their domestic law. In these cases, the same person can be taxed twice on the same income in more than one country. This result is known as juridical double taxation. So although this sounds conceptual wordings, we will split this into these three conflicts, which will give you clear meaning of what is juridical double taxation. So there can be three conflicts. We already understood in earlier side, there is something called source jurisdiction. There is one more thing called resident jurisdiction. So there can be these three conflicts: source conflicts, resident conflicts, source resident conflict. What are those? Let us see the meaning and maybe an example to understand. Source conflict. Here, two countries, both of them assert that the source of income of the taxpayer is in my country. And each country contends that it is entitled to impose tax on the taxpayer's income derived from that source, which is in dispute. Consequently, the taxpayer suffers tax twice on the same income. What is the example for this? So there is the domestic law of country A. It may state that income from shipping operations is sourced in country A if the ship that produces the income sails through its territorial waters. So you are aware India also has territorial waters. So a ship is passing through the territorial waters. So we will deem it as, say, shipping operations carried out in India, for example. Then, while domestic law of country B may state that income from shipping operations is sourced in country B if the cargo or passengers that produce that income embark in country B. Something like, say, Denmark, from there, some dairy products are being exported. And Denmark says, when the shipping operations start from our country, this is where the source is, so I would like to tax it. Now, here we have a conflict because we have country A, which is saying just because the ship is sailing through the territorial waters, income is accrued to country A. And country B is saying just because the passengers and cargo embarked on the ship and started the journey, from there, because of that, the source of income is in country. This is called source conflict, because country A would like to tax the income, country B also would like to tax this shipping company as such. This is one conflict. Next, residence conflict. In these cases, this is a classical case where an assessee can be treated as a dual resident. So in our example here, Hungary may consider a company resident of Hungary for tax purposes because the company was incorporated under Hungarian law, which is on par with Indian law as well. You have seen that if company is incorporated in India, you deem it as resident in India. While Poland may consider the same company a resident of Poland for tax purposes because the company has its management office in Warsaw. Warsaw is in Poland. So as a result of that, Poland says, when it comes to residential status law, as far as Poland is concerned, any company across the globe, we deem it as a resident of Poland if the directors of the company are in Poland. So here it is. Hungary is telling the company is resident of Hungary. Poland is telling, based on management, the company is resident of Poland. So as a result of that, we have a resident conflict. So both countries would tax that company, and hence it results in double taxation. Let us go to the next concept, source residence conflict. This is by far the most common conflict in international taxation. You might have seen umpteen number of these kind of situations whenever you issue your 15CB certificates. In these cases, one country asserts the right to tax a taxpayer's income as a taxpayer's country of residence, and the other country asserts its right to tax taxpayer's income as country of source. Let us see the example. Country R will assert its right under its domestic law to tax the worldwide income of a banking corporation, because banking corporation is there in country R, being a company resident in country R. Well, country S will legitimately assert its right under its domestic law to tax profits of the bank's branch. So country R has the banking corporation in its country. Country S has bank's branch. So what? The profits of the bank's branch are taxed twice. This is interesting because the source of the income is in country S. But because it is a branch of the banking corporation in country R, the profit and loss account rolls back and gets clubbed into the profit and loss account of the head office, which is country R. And on the global income, country R is taxing it. And hence, branch profit is taxed in country S. It is also taxed in country R. Mind you, country S, being a branch, is not a resident. It is only a formation of permanent establishment. As per the international tax concepts, it is still a non-resident, but because of its operations in country S, the source of income is in country S. So country S asserts its right to collect the taxes as such. So this is source resident conflict. So I think now you have understood the entire concept of the double taxation as such. You have understood economic double taxation. What is juridical double taxation? Economic double taxation can be predominantly national, occasionally international, but concept-wise, yes, it exists. Juridical double taxation, two countries taxing same income because of mainly these three reasons of conflict. Now, the point is, each of the countries have the reasons to tax the assessee in their own countries. As a result of that, one thing is guaranteed now, double taxation exists. So all of us are clear, double taxation exists. if that is the case, what is the relief to double taxation? This necessitates us to go through several materials that are important at the international tax law documents. There is nothing called international tax law, so it is more to do with every country has its own taxation law. When it applies its domestic law to international transactions, and for each transaction, multiple countries try to apply their own domestic laws, the international taxation concepts and liabilities emerge. So I can say it is culmination of multiple domestic tax laws, which leads into, or which leads to a terminology called international tax law. Otherwise, there's nothing called international tax law. There's no law for international tax. It's all domestic tax law. The interplay of domestic tax laws of different countries to a particular transaction or to a particular associate, is termed as international taxation laws. So now the double taxation is guaranteed. What are the reliefs that we will get from double taxation? So the double taxation relief as such would take place whenever the countries meet and agree for double taxation treaties. And apart from that, unilaterally, certain countries would tell that, okay, we want to protect double taxation to our citizens, so we would give them certain benefits unilaterally. So the classic example, Section 90 of the Indian Income Tax Act gives sovereign powers. Under the sovereign powers, the CBDT is empowered to sign the tax treaties with other countries to eliminate the double taxation. Section 91 is where we have a concept of unilateral relief to double taxation, where in case of certain countries or certain transactions, if double taxation treaty is not covered, then Section 91 can be applied to get the double taxation relief as such. So let us see some of these methods. Again, giving a warning for your understanding here. It's important because the methods I am talking about here may be followed in India, may not be followed in India. Some methods may be followed only in foreign countries. So these three methods we are understanding from the international tax aspect first. Exemption method. So under exemption method, a resident of a country R, are taxed only on domestic income. That is income derived from country R. Country R does not tax foreign sourced income. This method of double tax relief completely eliminates the source relief residence conflict. So why is that? Because the country R is telling, I am fine with the taxes that I collect from my assessees for the resident income that they get. Foreign income, I don't want to tax. This is called exemption method. So, of course, these are the places where this can result in some sort of tax haven as well. But then again, this is there. Here we can see two types of exemptions: full exemption, exemption with progression. What is full exemption? It is about eliminating the entire foreign sourced income from taxation, so that finally the assessee is paying tax only on the domestic income. So definition is very simple here. Exemption with progression. So this is an example. It says, suppose that a resident of country R derives income of 50 from country R and income of 50 from another country S. The tax rate in country R is 35% and tax rate in country S is 40%. So you have worldwide income of 100. Foreign tax payable is 20. Domestic tax payable is 17.5. So total tax payable is 37.5. For example, the full exemption method is employed in Australia in relation to gains or loans from certain foreign venture capital investments. So here, the point is, although the foreign tax payable was 20, the country chose only to collect domestic tax, which is 17.5. So in double taxation, it could have resulted in collection of 37.5. If we apply exemption method, only 17.5 is payable as taxes. Exemption with progression qualifies with full exemption method by allowing country R to take the amount of exempted income into account when determining the tax to be imposed on the non-exempt income. Exemption with progression does not dilute relief from double taxation. It simply imposes tax at a higher rate on domestic sourced income. So what is it? Country R is having 35% tax rate, say 50 is the income, and 45% for income from 50 to 100. When country R takes into account the exempt income of 50 to calculate the tax payable by its resident, it aggregates domestic and foreign sourced income. It will compute the total tax on the total income, an amount to which 45% rate applies. Under the exemption with progression method of eliminating double taxation, this rate is applied to the non-exempt portion of taxpayers' total income. So exempt portion is removed as such. This is the meaning of exemption with progression as such. So here, same example, country S, country R 50, 50, worldwide income is 100, applicable domestic rate is 45. So 45 foreign tax payable on foreign source income is 40% of 50, which is 20. Domestic tax payable on domestic source income, only 45% of 50, which is 22.5 as such. The total tax payable could be 42.5, but here, because the tax rate is at 45%, both the incomes, that is 100 into 45% leads to this 45. If you see this applicable domestic rate, kindly consider this as value as well. I'll explain the working to you. 100 at the rate of 45% domestic tax is 45, right? And domestic tax payable on domestic source income is only 22.5. So instead of 45, because 40 is considered for foreign tax payable, 20 plus 22.5, 42.5 alone will be the tax liability. Here we can take example of Netherlands. It applies the exemption with progression method as a general rule in domestic law. This method is also adopted in Australia in relation to foreign source income derived by tax residents of Australia under certain circumstances as such. Then comes the foreign tax credit method. So now, in the earlier methods, we have been applying on the income, trying to see can we exempt the income itself from taxation. Now we are looking at, in case the tax is given as a credit, how the method would work as such. So here we have two types, full credit method and ordinary credit. Country R may allow its resident to claim a full credit for whole amount of tax paid in country S on residents' foreign source income. So it is a very clear example. It only tells that, foreign tax in this example is 50 or 40 is 20, domestic is 35. So it is 35 on 100. You can observe here, total income, domestic and foreign is 100. 35% is applied on 100. So tax liability in domestic is 35, including the foreign income. But on foreign income, 20 is already tax paid. So in a full credit method, entire 20 is allowed as a credit. So 35 minus 20 is leading to 15 as the tax payable in country R. But you have to note here, total tax payable is 35, because at 35, that is the maximum tax that is payable. After FTC, 15 is the tax discharge. So total paid is 35 only and not beyond that. This is the full tax credit. What is ordinary credit? Normally, a country of residence would not allow a full tax credit, where the latter country's tax rate is higher than that in the country of residence. Assume we have a tax rate of 30% on a source of income. On a different source of income, the resident country has on the other country, has 40%. So in the domestic, how much tax credit? Because if we give 40, it is like, we are giving more credit in terms of percentage terms than the tax rate prevailing in the domestic. So we'll look at the example for better understanding. Same example, country is 50, country R 50, worldwide income is 100. Foreign tax payable on foreign source income is 20, that is 40% of 50. Domestic tax payable on domestic source income is only 35, that is 35 of 100, 35. Now, the important thing is ordinary credit for foreign tax paid on foreign source income is computed as 17.5. It is explained in the note here. Calculation of ordinary tax credit, maximum credit available is equal to foreign income divided by total income into domestic tax. So we are taking only 50 at 35%, which comes to 17.5. So 35 minus 17.5, payable in domestic country is 17.5. So here in this method, the total tax payable will be 37.5 at such, because the tax credit is not fully given. It is given only to the extent of the tax rate that is pertaining to the domestic country as such. So this is called as ordinary credit. Next comes the deduction method. This is not very popular, but some countries may still use it, but it is not very popular because it is not eliminating double taxation by any. It is, in fact, eliminating double taxation at a very low. So under this method, tax credit is not given, income also is not exempt. So what is it that they're trying to give? The foreign tax that is discharged in the foreign tax country is given as a deduction, like any other expenditure, from the taxable income in the domestic company, and the balance income gets charged at the rate of tax in the domestic company. Here is the example. Foreign sourced income country S is 50, domestic source income country R is 50, worldwide income is 100. So foreign tax payable on foreign source income is 20, worldwide income is 100. Now, what is taxable income in country R? Here in deduction method, they are giving 20, which is the foreign tax paid 20 as a deduction from 100. 80 becomes a taxable income in country R. So 80 at 35%, 28 becomes the tax in domestic, and foreign already 20 is that. So 20 plus 28 on 100, the tax paid is 48. Here you can clearly see the entire double taxation is not eliminated. A little proportion of the double taxation alone is eliminated. So this is another method, but not very popular. Now, here it is, just to do the recap, we have understood relief to double taxation because there is all these kinds of conflicts, source to source, residence, source, residence. So we need relief. Relief is given by way of exemption method where you eliminate income itself, tax credit where you give foreign tax credit in the domestic country, and deduction method where you give deduction of the foreign tax paid from the taxable income of the domestic country. So which country uses what? It depends on the domestic law of each country. India as such uses ordinary tax credit. The full tax credit would not be allowed. It's quite challenging if we claim that. But of course, wherever the foreign tax credit or a double taxation relief is not given under the tax treaty, in such cases, India allows Section 91 deduction, which is a unilateral tax credit, where we compute the tax that has been paid on certain income in the foreign country, and that is given as a credit in India, although double taxation treaty does not talk about it. So Section 91 can be claimed as a relief in places where tax treaty relief is not provided. Next concept is on double non-taxation. This leads to very interesting scenarios because just now we discussed everything about double taxation. We told everywhere it's a problem to the assessee. He's paying the taxes twice. Credit is not being given fully. What is he supposed to do? He's suffering tax in both the countries, etc. But suddenly we have a situation where there is double non-taxation. So this is a situation where the taxing rights of a country is not satisfied in certain cases, either on source basis or on the residence basis. Because the domestic tax law may be so worded that certain incomes may not get taxed in a country if certain conditions are satisfied or not satisfied. These are the cases where it may lead to a situation of, say, something like a tax haven, where an assessee may lead to not paying taxes anyway. So this is normally also referred as treaty shopping. A scenario, we have to just take one step back before the 2017 grandfathering amendment in Indo-Mauritius Treaty. According to the treaty, it had said earlier that capital gain transactions are taxed at resident contracting state. As per the domestic laws of Mauritius, there is no tax on capital gains. So assume there is a company in Mauritius and it has shares in an Indian company. And that Mauritius company sells the shares of the Indian company. So here, as per India and Mauritius tax treaty, the taxing right is transferred to resident contracting state and not the source. Shares are of Indian company. So India is the source country. Company belongs to Mauritius. So it is a resident of Mauritius. So as per the treaty, the taxing right of the capital gains was given away by India in favor of Mauritius. And interestingly, as per domestic laws of Mauritius, there was no tax on capital gains. This typically results in double non-taxation. So this led to forming a company in Mauritius and thereby carrying out transactions through such entity and escaping taxation of income. However, this has been taken care by amended protocol from 2016 onwards. So post that, this kind of a benefit is not there, at least in this treaty. I mean, this is the same example we saw. So the US company is there, it just creates a fictitious company in Mauritius, which in turn invests in Indian shares. And say in case India was supposed to tax it, it could have been a 10 to 30% capital gains tax. But because of the treaty with Mauritius, India will tax it at 0%, and Mauritius also taxed at 0%. So this was the position earlier to the amendment of 2016 protocol. So double non-taxation led to several BEPS action plans as such. Now, this gives us an opening into one more aspect of international taxation, that is, taxation laws as such are so complex, and each country has its own basis of levying tax. And that being the case, when the bilateral treaties are entered into, there would be several meanings associated to definition of incomes or definition of taxes, definition of residence, definition of permanent establishment. So it becomes multiple definitions or multiple, methodologies of international tax policies. This leads to very problematic situations because there will not be any uniformity of taxation, of international taxation, at least, among the countries, which again may result in either double taxation, double non. This led to formation of several organizations which had to take several policy decisions and give recommendatory policies to all the countries, constituent countries, to follow them as conventions. So this basically started somewhere in 1922 when there was OEEC, Organization of European Economic Cooperation. And prior to that, there was League of Nations. So we go back to history, we'll listen to all this. And in fact, League of Nations already covered certain aspects of double taxation, and it had certain conventions. And that was taken as a basis by OEEC. And later in 1955-56, OECD took over from OEEC, and then it came up with several tax policy decisions as such. So this is where OECD, formed major contributor in terms of, resolving several issues in double taxation. Here I mean to say such huge amount of efforts and analysis and recommendations have been made, for which all of us are the beneficiaries, and the double taxation treaties has become quite simplified. Imagine otherwise each treaty would look different, right? So they come up with certain policies and they release something called model tax conventions, right? So these model tax conventions normally define definitions like residential status. It defines what is permanent establishment, what is transfer pricing, what is arm's length principle, how to tax a royalty, how to tax an interest, where is the place of accrual for a share in, say, capital gains. So several of these concepts are standardized, and as a basic convention, right, there are model tax conventions that are released, and based on which double taxation avoidance agreements also have been drafted. Those we will see as it comes. So OECD, this is the introduction, and then it went on to issue several guidelines, went on to make several policies. Those became the input for several treaties, and many taxation amendments even at the domestic level because of the suggestions that came from the OECD as such. Now, to just take one step back, we are on double non-taxation and then at BEPS. So when we are talking about BEPS, why are we talking about OECD? OECD later realized, somewhere in 2015, these tax treaties have created scenarios of tax havens, wherein countries are not paying any taxes at all, or paying very, very low tax. In fact, this majorly applied for very large companies, because sometimes the international tax planning becomes a little more costlier for any small assessees to plan as such. In fact, there are certain classic examples, even which say something like Apple computers, possibly for 3-4 years, they paid very, very minimal taxes, not more than 1 to 3% kind of taxes, because a lot of their profits were structured through Ireland. So these things led to OECD considering a concept called base erosion and profit shift. And that constitutes BEPS, the BEPS as such. And they started telling, under the BEPS, we're going to recommend action plans for each of the constituent countries. So in case you adopt these BEPS action plans and apply in your domestic law, in your tax treaties, then we will be able to tackle base erosion and profit shift. So there are 15 action plans that are there here. We are not delving into detail of each of it, but we're just understanding the basic concept of this action plans as to what are this, what would be done in this as such. So action plan 1 is on the digital economy. In Indian parlance, if you see, significance economic presence has been introduced under Section 9. Concept of equalization levy has been introduced. The business profits are taxed in India based on source rule through above updates, which in turn leads to double taxation. Now, why was this necessary? There were cases where, especially if you take something like a digital business, there are possibilities that companies can be set up in tax havens. Assume, say, in Cayman Islands, where business profit is hardly taxed at all. And assume from Cayman Islands, the business is happening in India through online. So because of non-presence of an entity or a permanent establishment in India, India failed to tax such things. But Cayman Islands, as it is exempted, as a result of that, entire business is tax-free. But with the introduction of significant economic presence, Section 9 brought in certain criteria on satisfaction of which income is accrued to be in India, although the business is set up outside India and although there is no PE. This is where BEPS action plan has been adopted by. The action plan, digital economy, there are certain clues that are given under this, and based on that, India also has adopted for its tax as such. Action Plan 3, effectively controlled foreign company. There is no specific rules on CFC under the Income Tax Act. However, in order to encourage repatriation of profit, Section 115 BBD provides for a concessional tax rate at 15% on dividends received from specified foreign companies. But CFC rules are not there in India, but indirectly 115 BBD allows certain concessional tax rates in such cases. Action Plan 4, interest deduction. Section 94B is a very important section. It has been introduced to provide cap on claim of interest expense by an entity to its associated enterprise. So what does this mean? There's a holding company in US. There's an Indian entity that is that. Holding company gives the loan and it says interest is at say 30%. So on $100,000, $30,000 is the interest. Now the point is that 30% interest reasonable? So Action Plan 4 has given cue telling that wherever you feel the interest expense is high, in those cases, bring in a provision under the domestic tax law, certain portion of it disallowed. That is what is the plan under Section 94B. That is the reason why something like Section 94B has been introduced in the Indian tax laws. Action 6 as such talks about treaty abuse. Here is where introduction of LOB clause is there in India-Mauritius Treaty, India-Singapore Treaty as well. In all these treaties, earlier there were several tax benefits, either in terms of zero taxes or low tax rates. The LOB clause, in essence, means limitation of benefits. So what is limitation of benefit? As per the tax treaty, there are certain benefits given to you. So in India-Mauritius Treaty itself, we saw wherein India exempted the taxing, gave away the taxing right for capital gains. Mauritius said, we will not tax capital gains. So that led to a situation where there was double non-taxation. In order to curb that, LOB clause was brought in. And LOB clause in the India-Mauritius Treaty tells that, okay, this exemption we will give provided there are certain conditions that are there. If you meet that, we will. So it is more to do with whether there is substance that can be established to show that Mauritius is just not a conduit company or a tax evasive company. It is in fact an operating company. So everybody knows, obviously, something in Mauritius somebody has created, there would be an element to tell that, okay, there may not be economic significance or there may not be substance. So LOB tries to fix that, telling that you have a proper office, do the proper business, take the tax treaty benefit, then it is fine. Same thing happens in Singapore as well. And the treaty tells in Singapore, you form a company and you transact with India and lower tax rate for capital gains is applicable, provided in Singapore you have a proper office with employees and you spend 200,000 Singapore dollars in India. So can you look at the limitation of benefit clause? I cannot straight away take the benefit from the tax treaty. I have to satisfy certain conditions. Then only I get the benefit of tax treaty. And hence these clauses are limitation of benefits. It is limiting the benefit of tax treaty by imposing certain conditions. This is one more action for double non-taxation. Action 13, transfer pricing documentation. India has incorporated master file CBC reporting. We have Form 3C EAA and the other forms which have been mandated now on satisfaction of the turnover conditions. The Form 3C EAA, the master file CBC reporting has to be done every year in India now by November 30th. So how does this impact? Earlier TP documentation was only between India and the associated enterprise. There is a software development from in India. Marketing is done in USA. So between India and USA, there is a transfer pricing document. But then the affairs of the company is so arranged that the presence of that company is there across, say, some 10 countries. So out of those 10 countries, each of the countries, what functions are they doing? So at the head office level, is there a consolidated transfer pricing report that is prepared? Are all the transactions clubbed and at the head office level, a master file is being prepared? If that is so, then India tells that is fine. That master file we will consider. You don't have to prepare one more. Then there is CBC reporting. It is country by country reporting. And on satisfaction of the turnover criteria, CBC reporting becomes mandatory, and it says in each country, what are the transactions, what is the value of income, what are expenses, what is profit declared, and their functions, assets, and risks are being reported as such. So here again, Action Plan 13 is trying to tell any base erosion or profit shifting happens from India to some other country can be put to check, provided there is enough disclosure in terms of transfer pricing documentation, and that transfer pricing documentation is extended in terms of filing master file and country by country reporting. Action 15 is the most significant step that could have happened with the BEPS as such. This led to introduction of MLI, it is multilateral instruments, and notified covered tax agreements. Now, if you take any agreement, it is bilateral tax agreements. So to my assessment, there may be around, say, 1,900 to 2,000 bilateral tax agreements. There are several countries which transact with each other. So they have tax avoidance treaties among them. I see the number between some 1,900 to 2,000 treaties as such. Now, if you look at these concepts, what we saw now, action 1, 2, 3, 4, 5, 6, etc., all these action plans, how do we implement? Because if you start implementing, that leads to, again, non-standardized implementation of BEPS action. So they had to introduce something called as Multilateral Instrument Convention, MLI convention. So these convention lists down telling that introduce limitation of benefit clause by this. Tell that an office is necessary, employee is necessary, and certain kind of a monetary limit is necessary, right? So this, multiple countries would agree to do it, and then later would sign synthesized text of double tax agreements with their other bilateral agreements. So that is why in India now it has become very imperative. You may be issuing a 15 CB and you're thinking that I'm looking at bilateral tax treaty. Based on that, this looks fine. I'm going to issue my 15 CB. The interpretation is done. But the point is, a lot of MLIs have already come. The multilateral instruments as such, in each of these cases, have made certain changes in the articles. Some of these changes in the subsequent slide, I would get it. I will certainly take you through those. We will go to tax treaty and then go back to MLIS. So what is tax treaty? So I hope just to give a revision of what we learned earlier, double taxation concepts, tax treaties, the types of double taxation, all that we completed. Then we are in double non-taxation BEPS action plans. And from BEPS action plan, we are in tax treaty. Double taxation is eliminated or relief is provided through tax treaties or double taxation avoidance agreement. Tax treaty is a bilateral agreement. There are only two parties to it. It is made by two countries. It issues involving double taxation of passive and active income of each of their respective citizens. Income tax treaties generally determine the amount of tax that a country can apply to a taxpayer's income, capital, estate, or wealth. Any of these taxes can be covered in the treaty as such. A resident of either of the contracting state can obtain benefits under the treaty. Tax residence certificate is one of the major documents of DTAA benefits. One step back, residents of either of the contracting state can obtain benefits under the DTAA. This line is very, very important. Look at the concept in which the entire tax relief has been framed. The intent of the tax treaty is to provide the double taxation relief to the assessee in the country of residence. So what does this mean? The country of source is allowed to take its share of tax, and that much portion is allowed as a tax credit in the resident country. That is why residents of either of contracting state can obtain benefits under the DTA. This looks to be a very, very simple line item, but As you look at some practical scenarios, you will find it very, very challenging. The reason is that assume based on citizenship, US is taxing an individual. So he becomes resident of US based on his citizenship. India talks about stay in India more than 180. Now there is a person who is a citizen of USA staying in India for more than 183 days. He becomes resident of USA as well as India. Now all this while we were thinking of double taxation of income. Now we are looking at dual residential status. This dual residential status, we cannot take it for granted and move ahead because of this line I read now. Residents of either of contracting state can obtain benefits under DTA. So in this case, which country will give the double taxation relief? This is the reason there would be a separate clause in the tax treaty called tiebreaker test. And it says, where is the tiebreaker test has a couple of conditions based on which you can determine the assessee is a resident of which country, which in turn will tell you this is the country where you can claim the tax credit as such or the double taxation relief as such. So resident of either of the contracting state can obtain benefits under the DTA. Now, the individual I spoke now is both citizen of US and is also resident of India. So what do we do? So in this case, we have to have tiebreaker test, and it says, where is he more economically connected with? That can be one criteria. If in both places he is economically connected, then it tests where is his habitual abode? Where does he normally stay along with his family? Now, that also he stays in both the countries. Then there is a mutual agreement procedure between the countries. In those cases, the countries can agree together, telling that in such cases, this is how we are going to share our taxing rights as such. So these are the aspects that gets covered under tax treaty. The provisions of DTAA shall override provisions of Income Tax Act. Further, taxpayer can opt for provisions of Income Tax Act or treaty, whichever is beneficial. So under the Income Tax Act 1961, Section 90 provides relief for double taxation through treaties, DTAA. The relief provided through DTAA is called bilateral relief. Currently, India has a tax treaty with more than 80 countries where bilateral tax relief is available. In case there is no DTAA between a country, then double taxation are eliminated in those cases by way of providing unilateral relief tax credit method under Section 91 of the Income Tax. So Section 90 and 91, I think I've been explaining for a while now, so I'll pass this. Let us look at an important case law as far as the tax treaty is concerned. The Supreme Court in the case of Union of India and another versus Azadi Bachao Andolan case is a landmark Supreme Court case. The court has ruled that in case of any inconsistency between provisions of Indo-Mauritian Treaty and Section 90 of the Income Tax Act, the provisions of the tax treaty being specific provisions regarding providing tax relief in case of double taxation would override the provisions of the income tax. So according to this, the central government is, see, the Supreme Court went on to say, central government has sovereign powers under Section 90 to enter into tax treaty with other country. So if sovereign powers of the country, based on that, the heads of the country determine that in order to have good economic relations with the other country, I would like to enter into this tax treaty with the other country. It has to be given respect and it has to be given effect to. So in that case, the assessing officer's contention that treaty benefit should not be given was quashed by Supreme Court and the benefit was awarded to the assessee. One more classic case is on Brinda Ramakrishna versus ITO. Recent case law, some couple of years back, it was held that provision of tax treaty overrides domestic law and assessee shall not be denied foreign tax credit if Form 67 is not filed within due date of filing return of income under Section 1. In that specific year, when Form 67 was introduced in order to claim foreign tax credit. So Form 67 basically does the tax computation and tells so much of foreign tax credit an assessee is claiming. That number is taken into the income tax returns and foreign tax credit is claimed. So in this example, foreign form 67 was not filed by the assessee before the due date of filing the return. So assessing officer said, no, will not give you the tax treaty bill. As a result of that, it went into the litigation, and here it was held that form 67, although it is not filed, sovereign powers, override this procedural matters, and hence when tax residency certificate is there, the treaty benefit should be given. Similar kind of judgment came in GSEC and Devrient India Private Limited as well. This was on dividend taxes. So this is basically to understand what is tax treaty. One more important aspect possibly I could not cover in the PowerPoint presentation is how the tax treaty looks as such. So I would recommend each of you to go to the income tax website. Under the international tax tab, you get tax treaties. You can go there and go through several tax treaties that are available there. But in principle, how the construct of the tax treaty would be that it starts with the tax treaty is between who? What are the taxes covered? Residential status, permanent establishment, immovable property transactions, how to tax it. That is Article 6. Article 7, business profits. Article 8, related party transactions. Article 9, dividends. Article 10, capital gains. 11, 12, 13. It depends. Each treaty may have a different numbering as such, but normally it is interest, royalties, fees for technical services, those. And it goes on and it talks about dependent personal services, independent personal services, discrimination clauses, how to handle that, exchange of information. So the entire construct of the tax treaty has to be read in order to understand the understanding between two countries as such. Now, we saw what is tax treaty. Now we are coming to model tax convention. This phrase I had mentioned when we spoke about the OECD model. I had mentioned that resulted into formation or recommendation in the form of several model tax conventions. So what is a model tax convention? Countries generally use models as a starting point when negotiating tax treaties. The model convention is intended to provide a basis for double taxation agreements between different countries, and many DTAs follow the articles in the model convention quite substantially. A draft model double tax convention, including commentary on each article of the convention, is a comprehensive document. But from the perspective of which country is entering into agreement, the conventions may differ. OECD normally is resident-based taxation. Normally, it is associated with developed countries. UN Model Tax Convention is more inclined towards source-based taxation, normally associated with developing economies. Why these kind of tax conventions developed? As and when the disparity between the developing countries started increasing, of course, the development should happen in the developing countries. So there is more opportunity for business in developing countries. So you see investments coming from developed country to developing. But when investments come in and the profits are earned, those profits are just taken away to the developed countries as such. So in those cases, the developing countries started telling that you are giving the employment, business, all that is fine, but then the entire right to taxation you are taking away. So that is the reason UN Model Tax Convention came up, telling that in case of developing countries, they would like to tax certain income on source basis. That is why something like you tell royalties and fee for technical services, we would like to tax at say 10%, 15%, 20%. Depends on country to country. Article 23 of OECD and UN Model Convention speaks about elimination of double taxation. So this elimination of double taxation is where we see the methods, either the exemption method, foreign tax credit method, or deduction method, where double taxation can be avoided. So these are the differences. Residence principle we read, we said developing countries, source principle, that is fine. Income, India is not member. In OECD, India is not a member, but observer status. But keenly keep observing all BEPS initiatives, action plans India has been doing very keenly, because wherever taxing is possible, India is quite alert. and it follows that route. Income should be taxed where it arises is what UN tells. So basically, the source and residence based is the main differences here. These are certain examples. Probably it will be there in the PPTs, so we can go through that. Then comes the multilateral conventions. So with change in business conditions and scenarios, there will always be a need to update tax treaties for fair taxation and elimination of double taxation. Updating each and every individual tax treaties is difficult and cumbersome process. As a result of that, OECD introduced MLI. This is comparatively recent development. Somewhere in 2016 onwards, this discussions has started. Now, over 100 jurisdictions concluded negotiations on the multilateral convention to implement tax treaty related measures to prevent base erosion and profit sharing. So we had left multilateral convention in our BEPS topic in the earlier slide. I'm just resuming it after discussing the tax treaty to just give you the connection. The first signing ceremony for BEPS MLI was in June 2017, and it entered into force on July 2008. Up to date, 102 jurisdictions have joined the BEPS MLI, out of which 85 jurisdictions have ratified, accepted, or approved the BEPS MLI, and it covers around 1,900 bilateral tax treaties. Now, the Vienna Convention on Tax Law Treaties is an international agreement regulating treaties between states known as Treaty on Treaties, because that is where we draw all the interpretations and the meanings from. It establishes comprehensive rules, procedures, guidelines for how treaties are defined, drafted, amended, interpreted, etc. An international treaty is a written agreement between international law subjects reflecting their consent to the creation, alteration, or termination of their rights and obligations. So the Vienna Convention is regarded as one of the most important instruments in treaty law and remains an authoritative guide in disputes over treaty interpretation. But that has been very, very long back, and the business dynamics across the countries have changed. And especially with the digitization, the entire economies have changed the way they function the businesses. So we need to understand how MLI works. A country signs MLI. It notifies DTAA entered with other countries under covered tax agreement. So that tax treaty to which MLI the country would like to implement, it comes under covered tax agreement. Once a tax treaty has been listed by its two treaty partners, it becomes an agreement covered by BEPS MLI. Each contracting state can discuss on which provisions they wish to modify and amend their treaties. Once both the countries agree to modify their treaty in accordance with MLI, a new treaty comes into force and a synthesized text will be released. We'll come back to synthesized text word again. It is quite important. What is India's stand on MLI? India has signed MLI in June 2017, ratified in May 19. India has notified 93 tax treaties under covered tax agreements. While the signatories to the MLI include some of India's strategically important trading partners like UK, Canada, Germany, Japan, and France, some countries like US, Brazil have chosen to not sign the MLI. So you can see here, again, something like US, it is always, when we talk about model conventions, we tell OECD convention, UN convention, but always there is a US model, because being economically superpower, they dictate terms even in terms of tax treaty signing. As a result of that, sometimes they follow hybrid of OECD, UN, or they don't follow either of it. So it becomes very tricky. I can tell what can be deviation in a normal business profit scenario in the United States. In the United States treaties, especially with India also, if you see, there is something called force of attraction rule. So in case there is a permanent establishment that is present in India and the head office is in US IRS has the powers to determine additional profits from the PE and then tax it in US as such. Same thing applies in case US has a branch office, head office is in India, and it tends to use force of attraction rule and tends to take more taxes as such. So some countries like US, Brazil have chosen not to sign the MLI. Other countries like Mauritius, Iceland, Switzerland, and Germany, while signing the MLI, have not made it applicable to their tax treaty with India, unfortunately. But with other countries, they have. Synthesized text. Let us look at certain examples. These are going to be very important for us. It represents shared understanding between the two governments of modification to their treaty through MLI. CBDT periodically publishes synthesized text as when it is prepared till date. CBDT has released 32 synthesized texts. So some of the synthesized texts we have I've just given for reference here. As to why it is important, you can see. The country is Australia. In the tax treaty between India and Australia, what is modified using MLI is preamble, Article 1, Article 4, Article 5, Article 13, Article 25. Or what is the articles added? The PPT clause. What is the PPT clause? Principal purpose test clause. So for any transaction, the principal purpose test is tested. And in case the principal purpose is to evade taxes, then in those cases, the treaty benefit is denied. So it is important to keep in mind the PPT clause, even when you're doing normal international transaction analysis. Then we have Ireland, India, Preamble 4, 5, 13 amended. Article added anti-abuse rule for PE, PPT clause has been introduced. Japan, Preamble 4, 5, 9 and 13, PPT clause. UK, Preamble 1, 4, 5, 27, 28C, PPT clause. So why these are important? When you are checking at the double taxation treaty, with those countries with which India has synthesized text, along with the double taxation treaty, you should also read the synthesized text. And based on those amendments, you have to apply the tax law. So this aspect, we have to be very careful. 32 synthesized text. You can go to the portal, you will be able to see them and download. It is there in the international treaties, international taxation tab in the income tax website. So we will briefly understand what is principal purpose test, because that seems to be predominantly occupying as new article added in the synthesized text. To ensure fair taxation and eliminate juridical double taxation, there should not be way for escaping from taxes. So it is something like there was a good reason why double taxation treaties were signed, but people started abusing tax treaties, as a result of which they went into double non-taxation. The principal purpose test is one such measure to prevent treaty abuse and ensure the fair taxation. The PPT will have the effect of denying treaty benefits, such as reduction of withholding tax on interest, royalties, and dividends, where it is reasonable to conclude that obtaining the tax treaty benefit is one of the principal purpose of parties seeking to rely on relevant double taxation treaty. As a result of that, we don't want to give the treaty benefit. There is a carve out where granting the treaty benefit is nonetheless irrespective of the principal purpose of the taxpayer, in accordance with the object and purpose of the relevant double taxation treaty as such. So now we understand why principal purpose test has been introduced through the BEPS action plans, and those have made its way into multilateral instruments, and in turn it has made its way into synthesized texts of the double taxation agreements, which necessitates us to now look at synthesized text along with double taxation treaties in order to arrive at a tax position for a transaction. So now that the concepts we have seen, I thought we can discuss some of the incomes here. The taxation of incomes, normally the domestic laws of country provides rules and provides for taxation of income. So it says, how do you compute an income? That is not there in the treaty, that you have to look at the domestic. For example, house property income, you take annual value, give 30% reduction, interest, arrive at the net annual value for taxation. Income from house property. Go to US, it is not the case. They will allow maintenance expenses, depreciation, then arrive at the income from house property asset. So the methodology in which the income has to be computed is not handled in the tax treaties. Domestic law has to take care of the computation. When a particular income is taxed in more than one jurisdiction, it leads to double taxation. Yes, we agree. DTAA eliminates double taxation by way of exemption of credit method. We have already seen this part. Double taxation on each income is eliminated independently through separate articles. So what does it mean? Business profits, there is a separate article. Related party transactions, separate article. Royalties, fee for technical services, separate articles. Dividend, separate article. Capital gain, separate article. Dependent services, salaries. Dependent services means salaries. Independent personal services, individuals who are doing consultancy services, right? So each of their income are handled separately in separate articles. Business income of non-residents. There is a resident of USA. It has business income in India. So this is covered under Article 7 of Treaty between India and USA. The business profits of an enterprise of contracting state shall be taxable only in that state unless the enterprise carries on business in other contracting state through a permanent establishment situated there. If the enterprise carries on business as aforesaid, the profits of enterprise may be taxed in the other state, but only so much of them as is attributable to that permanent establishment. This is the typical wordings that I've used in Article 7. So the meaning is the resident of USA having business income in India through its permanent establishment. Then it will be taxed in India based on source as well as in USA based on residence. So now to avoid double taxation, resident of USA can claim a tax credit for the taxes paid in India against his tax liability in USA. So in India, whatever tax is paid, being a source country, US being a resident country, it gives the tax credit for taxes paid in India. Capital gains. There's a non-resident in India. A non-resident in India sells a land situated in India. Non-resident is not in India. Please don't get confused. Non-resident has in India a land and he sells it. That is the meaning of it. The above transaction is taxable in India by virtue of Section 5. Why is that? A non-resident normally does not have taxable income in India unless he has an asset, which is the source of generating income. Further, the non-resident is liable to tax in his country of residence based on residence-based principle. This leads to double tax. Again. So in such cases of capital gains, what do we do? Capital gain is discussed in Article 13 of the OECD and UN models normally. As per the basic principle of international tax, a country of residence always has the right to tax. The country of source may be given full, partial, or no rights to tax in Article 13. Some DTAA provides taxation rights to the country of source, that is where the asset is situated, situs of the asset. We call it as situs of the asset. Land situated in India, situs of the asset in India. While in some DTAA, the rights are given to country of residence, where the seller is a resident. In very few DTAs, example, India, UK, India, US, it is provided that each country can tax capital gains according to its own domestic law. However, double taxation is eliminated through tax credit in these cases also. Royalty income, one of the most popular topics, I should say, because India being a source for a lot of technologies, and many times, there are several technology related payments that would happen from India, because many times the intellectual property rights normally is in foreign country and we subscribe to several of their softwares or databases or anything like that. So in those cases, there is a user right to use of those rights in India, as a result of which, by definition, such payments are called as royalties. So in case of royalties, there is a separate article to deal with it. Normally, it is in Article 12, 13 kind of numbers. In this, we have taken example where income from royalty by a resident of US is subject to tax in USA. Nevertheless, the source country, say India, also retains the right to tax such income subject to conditions. To prevent double taxation, a resident of USA can seek tax credit for taxes paid in India against their tax obligations in the USA. So in Section 9, subsection 1, clause 6, royalty is deemed to accrue or arise in India. Section 9, subsection 1, clause 7 deals with fees for technical services. So as far as royalty is concerned, it has a very broad definition. It almost looks like anything that we pay for use or right to use may get classified under royalty income if it is not business income. As a result of that, invariably Section 9, subsection 1, clause 6 applies in several cases. So obviously, US being a resident country, the income will get taxed in India. And because of Section 9, subsection 1, class 6, royalties, although relates to a US company, gets taxed in India as such, because the right to use or use is in India. Okay. From that pretext, source country India, US is the rest. So royalty gets taxed in both the countries. So in those cases, how the tax credit has to be taken, Article 12 deals with the royalty. So these were few of the incomes. I thought in the interest of the time, we should cover how the international taxation works in such cases. Then we have latest developments in the international taxation in the form of digitalization and equalization. What are these? In the new age economies, technology is playing a huge role. So in the area of digitalization, there is no need of physical presence of an entity to conduct business. Entity established in one country can do business, earn income in another country without its presence in the other country. We have a classic example. We'll go to that in a little while, couple of slides more. Income earned out of its country of incorporation was escaping taxation due to non-existence of P. So we saw that the article, also Article 5 says what is permanent establishment, and Article 7 says the source country can tax the income in that country provided a permanent establishment is formed in it. This issue of digitalization was addressed by BEPS Action Plan 1, through which the government of India has introduced the concept of equalization levy as such. What is equalization levy? The digital age has provided phenomenal expansion to business. We saw that. It has made it possible to carry out business in multiple territories without physical presence. We saw that. However, the evolution of virtual world has turned into be a challenge for nations in exercising their taxing rate. Conventional taxation models never envisaged anything but a bricks and mortar world. More to do with goods and services, where we can perceive things. Now, in digital age, it has gone haywire. Sometimes we things seems tangible, but actually we are dealing with some intangible. So it has become that kind of economic activities. So for the equalization levy, the background is over the last decade, information technology witnessed exponential growth. This led to increased supply and procurement of digital services. New business models emerged, heavily reliant on digital and telecommunication networks. These models pose tax challenges related to nexus, characterization, and valuation of data and user contributions. Existing tax treaties lacked adequate rules for physical presence-based nexus, resulting in potential tax disputes. To address these issues, Indian government introduced the equalization levy as part of BEPS Action. Classic case. All of us watch Netflix. Now Netflix has Indian entity and all that. It's a different thing. But initially, when the concept of equalization levy and digital taxation, etc., came into India, this is how Netflix functioned. Netflix, a popular streaming on-demand entertainment content globally, faced tax implications related to its revenue and services. The equalization levy aims to tax digital services provided by non-resident entities, even when the seller is not based in India. So Netflix was there in a foreign country. All the users are in India. You have a huge subscriber base. You keep collecting by way of some online payments. The money directly goes into foreign countries. Huge user base in India, heavy business that is being done. So source is in India because you're watching the program in India, you're subscribing it from India. As a result of that, India, in principle, has taxing right. But again, this being a business income, for non-existence of a branch in India, Netflix income cannot be subjected to tax. As a result of that, following digital tax BEPS action plan, India said, okay, we would like to levy 2% tax on e-commerce or 6% tax on some digital transactions as such. So this concept of equalization levy is an offshoot of BEPS action plan that we can see. Netflix, being a non-resident company, could have potentially escaped Indian taxation on its subscription fees. However, Netflix chose not to pass on the impact of India's equalization levy to its consumers. By not passing on the levy, Netflix aimed to maintain consistent pricing for its Indian subscribers. In summary, the Netflix case exemplifies how the impacts digital service providers and consumers. It underscores the need for fair taxation in the digital economy. So you can see the international tax concepts have already moved into domestic taxes. We can see the influence of this. Taxation framework. What is the tax framework for digital economy according to OECD recommendation? Identifying nexus based on significant economic presence, withholding tax on digital transactions, equalization. So these are certain recommendations what the BEPS action plan has suggested, telling that this is how you can tackle the digital economy. So India also has prescribed under section the significant economic presence in case of businesses which are made in online, especially where you have something like a subscriber kind of thing, where it says, okay, you should have an income of more than 50 lakhs, then you should have more than 30 million subscribers. Then we deem that you have a significant economic presence. Once you have significant economic presence, the income that you are earning from in India, that we will subject you to that. So in case there is a foreign payment that is happening for digital transactions, we would do withholding. In case we feel that you are not paying tax anywhere and we would like to collect tax as a source country, we will levy this equalization levy of 2% or 6% as the case. So this is how digital economy was supposed to be tackled as per the BEPS action plans, as per the OECD. And this is being followed by the country now. So it was concluded that countries can introduce options in their domestic tax laws as an additional safeguard while respecting tax rates. India led the way adopting interim measures. India took lead in implementing interim measures like equalization levy in 2016. In Finance Act 2000, it broadened the levy of equalization levy by introducing equalization levy on e-commerce supplier services where non-resident is the owner of the business. Additionally, to prevent double taxation on revenue subjected to equalization levy, income from specified services or e-commerce supply by non-residents is exempt from income tax under Income Tax Act 1960. So you can see the kind of taxation they are bringing in by balancing the double taxation, but yet ensuring a fair taxing right is preserved with India. So what is the impact because of the equalization levy? The business profits of non-residents from rendering specified services or e-commerce supply or services are chargeable to income tax in their home country. With the enactment of equalization levy, the revenue giving rise to such business profit would also be subjected to tax enactment. So although there is no permanent establishment, we have established the tax impact. So in principle, that is what it is. And I mean, these are some of the rules that is there for significant economic presence. It is there in the presentation. It is there in section 9 as well. We can go through that. Next, we will conclude with few landmark judgments. The most prominent being engineering analysis is this. This was a very important case because India being an important country as far as the computer software production is concerned, or importer of several of the technologies is concerned. Whenever a foreign payment is made, Section 195 prescribes withholding of tax has to be done, and provided that income is chargeable to tax in India. Now, whether an income is chargeable to tax in India has to be tested by looking at Section 9. When a sale of computer software happens, we normally test whether there is a permanent establishment. If permanent establishment is there, the income goes into Article 7 and we tax it under business profits. If permanent establishment is not there, then we move to Section 9, subsection 1, clause 6, the royalty definition. Their royalty is deemed to accrue or arise in India if use of the asset or right to use of the asset is in India. So in principle, if I buy a computer software from a foreign country and it gives me user right to use of that, in principle, it was held that it is royalty, so there has to be withholding tax payment when the foreign payment is made. But then there were other serious cases that came in Samsung case, etc., which said, where the contention was about saying when we pay for the computer software, we pay for the copyrighted product, not for the copyright. So what we're paying for the product, not for the right, and because we are not paying for the right, it is not a royalty. So if it is not a royalty, the TDS implication should not arise unless there is a permanent establishment in India. So this resulted into perennial litigation. But to our advantage, Engineering Analysis Center of Excellence case came into picture, and Supreme Court held a beautiful judgment, and it at least resolved all our problems, at least in these 4 cases. Sale of software directly to an end user by way of end user licensing agreement. Sale of software by a non-resident to Indian distributors for resale to customers in India. Sale of software by a non-resident to a foreign distributor for resale to customers in India. Software bundled with hardware and sold by foreign suppliers to Indian distributors or end users. So these 4, the engineering analysis case has told when it should be taxed, when it should not be taxed. So it is very important to understand the royalty definition, the royalty taxation has been considered in detail in engineering analysis case. And the Supreme Court goes on to say that because the tax treaty is there, first go to tax treaty. Article 12 is dealing with royalties. It particularly uses the word copyright. And writing of the software comes under literary work, literary and artistic work, under the copyright definition in the Copyright Act in India. As a result of that, look at the conditions of copyright usage and whether any use has been given or right to use has been given based on section 13 to section 19 of the Indian Copyright Act, and then determine whether it is a royalty or not. So in several cases, we see it is not copyright that we are paying for, but we are paying for copyrighted product. As a result of that, in many software cases, we don't see TDS being applicable. So that is engineering analysis case. Very detailed judgment. I think you have to go through that. I have one in case of Bank of India, where Indian tax authorities cannot grant a refund of taxes paid in foreign jurisdictions. See, the entire tax mechanism is to divide the taxing rights. So in case 1,000 rupees is what India is supposed to get, it has to get 1,000. In case in the foreign country, if you have paid 2,000 and you tell that, give me foreign tax credit of 2,000. So I paid 1,000 more there in US. So you give me 1,000 in India. Not possible. So it says foreign tax credit should be restricted to the Indian tax liability, and there cannot be a refund out of the foreign tax credit as such. Omar, I think I can stop. We can tape the questions. Anyway, there are only few more case laws and it is for reference purpose. I'll leave it for the PowerPoint.
Yeah, since we are running out of time, it's better
Yes.
if we take the questions.
Yes, I agree.
So let me start with the questions.
Sure.
So CA Chinnappa is asking, I think his client is an Italian company. So the Italian company has its head office in Italy and branch in India. Head office got an order from PSU in India, and the head office also has a PAN in India, having PAN in India. Now PSU want to deduct tax at source and asking head office to submit for. If they deduct 20%, then will it get credit to PAN in India or can be transferred to head office account? If TDS gets credited to branch, then how to claim back from tax department? Whether branch is liable to declare the said income.
So quite a detailed question, I understand. Yes. I can over?
Yes, sir. So in this question, I feel Article 7 will be quite important, permanent establishment, because there is both a branch in India plus a head office. So Nexus will play an important role. What do you think, sir?
So we have to go again step by step in this case. So we are going to be the country from where the payments are supposed to happen. And as a result of that, the vendor from India has to see, are there any incomes accruing to the permanent establishment in India because of this transaction? So the vendor would see the operations where exactly it is going to take place. But vendor being a business entity, actually it cannot determine how much is the taxing rate. There is a limitation. There is a limitation I have to tell you. Because even if there is a PE, how much of the profits I can attribute to PE? Suppose 1,000 is the turnover. Suppose 1 crore is the turnover. How much of the profit of that 1 crore can I attribute to the operations that is carried on by the PE in India? Is a substantial question we have to answer. If we tell, say, 20%, then 20 lakhs is the taxable income in India. So 40% of that is, it becomes 8 lakhs, for example. But it is not so simple, because who will determine 20% is the taxable income in India? So this is where section 195 comes into picture. 195 bracket 2, 195 bracket 3. We have to take recourse to either the foreign country or the Indian vendor should approach the jurisdictional international tax assessing officer. They have to file these agreements, give the facts of the case. The assessing officer would go through, he will determine based on the functions, assets, and risks analysis, whatever we present to him, he will tell so much of the income is attributable to tax in India, and this is the tax rate of it. That can become the basis for doing the TDS in such cases. The vendor on their own, if they are doing the TDS, then it becomes a very problem situation, because as a foreign entity, you can question them. Look, the PE is doing only limited auxiliary activities. It does not have any role in whatever business we are doing in India, and hence there is no major income at all. So on the entire income, you're not supposed to tax. Kindly allow us to go to income tax officer and get a lower deduction certificate, or as a payer of the income, you go to the income tax officer and get a lower deduction certificate.
That's a very good
the
input.
most practical aspect in which we have to deal with this situation.
Right. It becomes a mini assessment also.
Of course, it is a mini assessment, because we have to carry agreements, contracts, invoices, vouchers, the P&L account, what is happening in India, what is happening in USA, entire thing has to be.
Okay. Next question. Which are the common errors made during double taxation avoidance agreement consideration, and what steps can be taken to avoid it recurringly?
I feel the documentation part of it is very important, because double taxation agreement, the double taxation relief is available when the tax residency certificate is provided. If the beneficiary does not provide tax residency certificate, you cannot invoke the provisions of the tax treaty. Now, India has gone up next level, and it is talking about Form 10F as well. And unless the Form 10F is uploaded online with PAN or without PAN of the foreign entity, you will not be able to claim the double taxation relief as such. So we will make a common error telling that, okay, let the agreement go through, let the transaction go through, the payment has come, tomorrow is the due date. Now we are searching for PAN number, searching for tax residency certificate, searching for P declaration. So preparatory process, preparatory steps to follow the process correctly is the biggest, I should say, challenge while implementing the tax treaty as such.
And also reference to the synthesized text, the protocol. What do you feel about that, sir?
So the precedences are not needed. So we have to wear the shoe of the assessing officer. We have to wear his assessment cap now and try to check, how do we interpret it best. But in case you feel primarily it is risky, as a chartered accountant, when you are issuing 15 CB, always 195 bracket 2 bracket 3 on section 187 is there to your rescue. I would say in case of risky transaction, don't shy away to meet the assessing officer and get the lower deduction. Let the tax rate in such cases be determined by the assessor. Of course, one more challenge, Omar, I also see is when there are multiple countries involved. Head office is in one place, service is in, say, head office is USA, service rendered by Singapore, marketing is in, say, Thailand, and Indian customer is making the payment. And Indian customer is making payment to, say, the marketing country, but the source country can be something else. Now, in these cases, the problem is which treaty to check.
Yeah, absolutely.
So those are the issues I feel are tricky that has to be.
Got it, sir. Another question is, next question is from Sumant, Mumbai. I had a case where the SSE was a resident in India, though a US citizen. He had paid taxes on his pension income in US. When we filed the return and claimed credit for tax paid in US, there was demand for that amount under section 143(1)(a). We filed rectification application under section 154, but the faceless regime again sent a demand for the amount of tax credit claim. Why is the faceless regime not giving credit for tax paid in US when all evidence and supporting of tax paid in US were given along with the return filed? Going for an appeal against under section 143(1)(a) is no solution. Why is faceless regime not giving credit for tax paid in US?
First and foremost, when you get a 143(1)(a) like this, don't do 154 alone. File for the appeal as well. For any demand that you normally get, rectification and appeal are parallel solutions, and you have to apply for both of them parallelly together. Unless you are 100% confident 154 is supposed to happen.
Yeah.
It is very difficult. So we ensure that 30 days time limit for appeal we should not lose. So we file also a stay petition so that the tax would not be collected. So practically, and you file 154. Now the point is 154 is rejected, appeal is still there, stay petition is still there, right? So, and then you go on to do transfer of the case to the jurisdictional assessing officer so that you can present the case better. You can tell them what is the use of faceless. Faceless has given huge advantages. We have already seen good orders that have been passed, but equally there have been troublesome orders. I am both for and against it as of now in its current form. But that being the case, I have to tell you, in one of the cases where I have filed the tax returns, same thing happened, not in case of pension, but it was salaries and other incomes. Form 67 was filed. All workings were given. Foreign tax credit was not given. Liability imposed 4 crores.
Oh.
Assessment year 22-23. Come assessment year 23-24. Same issue, same assessee, same income, similar FTC. Faceless not even faceless assessment, normal 143(1)(a) CPC proceeding. Tax credit given, demand 0.
Oh.
So I can only answer you telling that CTC is evolving.
Yes.
It is evolving. Just that these intricacies of the juridical double taxation, the tax treaty, right? Some of those things, the artificial intelligence is not able to catch it up yet. In those things, department or the finance ministry is not ready to give away the taxing rights. They want to take it back. They want to see, let us test it in the next proceedings and then see whether it is real tax credit or not, whether we should give it or not. So it is a matter of apprehension. We have faced several tax, inconveniences. This is one such thing, and we don't have an alternative. I'm sure if you pass on request for transfer of case to the jurisdictional assessing authority for rectification proceeding, you will be able to present the case better to get the TCS.
Yeah. But that will be only after the end of the assessment year, right, sir? Because rectification rights are normally transferred after the end of the assessment year. So you have to file appeal before that itself.
I know. This is all timing issues. So we have to face all these processes, go with appeal, file the stay petition, do 154, get this, go explain to the appellate commissioner telling us, please hold on, one more rectification application we are filing. This is the reason, explain the case. Many cases commissioners have agreed, yes, we understand. It's a concern, they've given time. We've gone back, got the rectification. So it has to be solved practically.
Okay, sir. I think this will be the last question. We have only 2 minutes left. Whether TDS applicable on remittance for exhibition held in Dubai by non-resident and payment remitted in foreign currency in Dubai. Non-resident has a branch in India, whether it has to be treated as PE for TDS under treaty.
The payment is happening from India?
I am assuming, sir. That is why this question is coming.
Because first I heard the payment is happening in the UAE.
In UAE. On
so if the payment is happening in UAE,
no, for an exhibition held in UAE.
Oh, exhibition held.
of a non-resident, by a non-resident, he is participating in an exhibition in UAE. He has a PE in India. So whether TDS is applicable or not. So it's a question of nexus, I feel.
Nexus also, and moreover, in case it is an expenditure that is incurred by the head office there, we have to see why the PE here is accounting for that expense in the first place.
Right.
If it is the expense relating to the PE here,
Yes.
then of course we can test. We are claiming that expenses. It is a foreign payment. It is a non-resident payment. 195 has to be tested. Check for the tax treaties, and see if the taxing is there here. But again, looks a little complicated. In such cases, I would go with the certificate of the income tax officer. But plain understanding of the case, I felt, if there is no nexus at all with the business that is conducted in India by way of this PE, then there is no point of going to the tax officer. It is a clear case. It is for the business conducted outside India, so income should not accrue it. So I think that is one position we can test. But in case of doubt, don't take a chance, because you are signing your certificate. So please go to assessing officer in such cases.
I think I will propose a vote of thanks now, because we have completed the allotted time. One thing, sir, in the comment section, in the question section, you are getting a lot of praise for how beautifully you have presented a complicated subject, which is an ocean in itself. You have simplified it. You have taken us through the basics, such as source, resident, conflict. Then you have taken us to the current events which are happening, that is MLI, BEPS. So it was a very comprehensive presentation. You have given us wide coverage. So we thank you for that. And I thank the support team from Direct Access Committee, who are doing an incredible job in putting these sessions together. It was a lot of effort. The preparation for these sessions actually start much before. So hats off to them for putting these sessions continuously together. And I thank all the participants. It was wonderful. The questions are amazing. It's unfortunate we can't answer all the questions due to shortage of time. And a lot of people have asked for the PPT. So I think that will be shared by the team at ICAI. And also this session will be hosted on YouTube for later on references. Thank you.
Thank you, Amar. Thanks, everyone.
Yes, sir. Yes.
Thank you, sir.